Hello, everyone. Today on the final bar, my guest is Julius de Kempenaer, founder of RRG Research and fellow host on StockCharts TV. We're going to talk about asset rotation, in particular, looking at stocks versus bonds. This is a ratio we've looked at on the show a number of times, but I think Julius's work really highlights this rotation and what you want to be thinking about going forward as the S&P continues this uptrend. Stocks again moving higher, up over 0.5% today. With leadership from comm services and technology. Ladies and gentlemen, this is the final bar. Hello, everyone. Good afternoon. Welcome to the final bar. This is your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to look at the markets together through the lenses of technical, behavioral, quantitative, sentiment analysis, and trying to understand the dynamics of supply and demand, fear and greed that drive asset prices. Most importantly, connecting the short term of what we're seeing today with the long-term trends and how they're evolving. And again, as we've talked about, the theme, I think, in the last week, if not multiple weeks, has been this, breakout to the upside, continuing to push higher. S&P 3400 has seemed like so far away, but we're pretty close. We're closing just below 3350 today on the S&P, which means we're a hop, skip, and a jump from making new all-time highs for the S&P. And along the way there, you've got leadership names and leadership teams that continue to go to the upside. Walt Disney, beating earnings earlier this week, yesterday, if I remember right, and gapping up yesterday, continuing higher today, and a lot of technology going along for the ride as well. We have a lot of great guests on this show today. As I mentioned, we have Julius de Kempenaer joining us, it's always a pleasure to have him on the show, get his take on what he's seeing using his lens of rotational analysis using the RRG. Next week on the show, on the 11th, which is Tuesday, we have Larry Tantarelli from Blue Chip Stocks. On Wednesday, the 12th, Jane Galena from cjanetrade.com. Then on Thursday, our next episode of The Pitch, and The Pitch is our sort of roundtable discussion. I'm actually going to be moderating this one. We'll have three guest presenters. We'll each be presenting 5 ideas. Going forward, they'll each have a couple minutes to present their 5 ideas, and then we'll discuss them as a group. We've done this for a number of times earlier this year, and it's just been a fantastic conversation. I've enjoyed moderating mainly because I get to chat with these guys and pick their brains and understand where their toolkits are pointing them. So it's going to be a lot of fun. Also, I miss it, but on Monday, this coming Monday on the 10th, our next episode of Behind the Charts, featuring a conversation with Josh Bellinger. So a lot of great guests on the show coming up this week into next week, and I wanted to move on now to our market recap. So as I mentioned in the introduction, the S&P continuing higher today, more of the same, with the S&P finishing just above 3349. So that key 3400 level not far off after this week. The NASDAQ up a little more, with the NASDAQ 100 up 1.25%, so leading the way higher. Noticeable, I think, today, mid caps and small caps actually finishing down on the day, so a bit of a divergence from the large cap space to some of the smaller companies there. Bonds higher today, so the TLT up over 0.5%, trading above 171. The dollar essentially flat for the day, really sort of chopped around for most of the time. The 10-year yields obviously lower on stronger bond prices. Interesting, I was talking with a friend of mine yesterday about precious metals, and gold continues to go higher, but silver, I tell you what, is a really fascinating story. I think we looked at this yesterday when I did this recap, and I was thinking, wow, silver keeps gapping up, or up another 7% today. So again, something like this extremely overbought. It's gone up a ton. It's one of the highest ranked ETFs out of our entire ETF universe, using the Scudo rankings, 99th percentile. It's about as good as you can get. So what does that mean? Overall, it recognizes the trend has been severe to the upside. It, in general, for me, flags it as ripe for some sort of pullback, but overall, tons of upside momentum, and certainly enough momentum to continue further upside over the long term. So an interesting chart right now with silver that keeps going up with the rest of precious metals to the upside. Let's look at a chart of the S&P 500, and then we'll continue on to some of the other themes out there. So here's where we're at. And again, since we've been talking about in the last week and a half, since we broke above 3,200, since we broke above the June high, I think that was the key. We did that mid-July, but really followed through with it toward the end of July into this week, and now we've continued further. And as we've talked about for a while, S&P 3,400 certainly, I would expect to be in the cards, and I'm not sure if that's going to be a finish line based on what I'm seeing, just with the momentum that you see to the upside. And again, months from now, we can look back and see these meteoric rises in stocks like Apple's and others, and think that there were some clear signs of frothy, exhaustion moves at the end of a big uptrend. But as a trend follower, I've learned to trust trends, and until proven otherwise, the equity market is in an uptrend, and that's the story. Also, really key to note here, I think a lot of people, including me, have focused on this bearish divergence, higher highs in price, lower peaks in RSI. But what I have learned is a divergence is fine until it's proven incorrect. And I think when the RSI level breaks above that second peak, it's now broken that pattern of higher highs and lower highs, the higher highs in price, lower highs in RSI. That pattern's now broken because we've now exceeded that previous momentum. So I don't think you can really consider that a bearish divergence anymore. There are other reasons why you can assume we might be topping out. There are breakdowns that I would be looking for that would certainly validate that, but I don't think we can consider the divergence a valid signal on a lot of charts now because of the resilience of this latest move. When you pull back, as always, I think it's key to start with the final bar, look to the left, and see where key support and resistance levels are. On any sort of pullback, 3,200 is a very important level. This is where the S&P pulled back to after that first attempt to get above the June high, sort of pulled back to 3,200, hit it a couple times, and then continued on. So you have a pretty good, I think, downside risk level. The 50-day moving average is getting closer and closer to that level. So I think on any pullback, that's where I'd be sort of eyeing a line in the sand. At this point, as long as we remain above there, I think we're continuing to be in good shape. And plenty of charts have emerged like Disney in the last 48 hours suggesting breakouts, not suggesting exhaustion. It's more resolving to the upside with potential for further moves from there. Having said that, let's look a little deeper at what happened today. Communication services, technology, number one and number two. It's sort of a familiar theme. That's the FANGMAN, FANMAG, MAGA, whatever we want to call it, trade continues to impress. And I mean, Apple is a chart that, full disclosure, in our paper trading competition, we have a competition amongst the producers and so forth, the team at StockCharts TV, and Apple is one name I am holding in that paper portfolio, and the reason is because it's been resilient to the upside, and overall, again, it's a huge benchmark name, up another 3.5%. And again, the challenge with charts like this, or not the challenge, but I guess the opportunity is, if you're managing a large portfolio and you're benchmarking your fund to the S&P 500 and you don't own a name like this, which is one of the biggest names in your benchmark, if not the biggest, and it's moving 3.5% at a clip and outperforming on the way up, you have to own it. It's not a question of whether or not you kind of want to own it. You literally have to own it, or else you cannot outperform. You are destined to underperform unless you can hold it. So there's a lot of pressure to own names like this. That's not going away, as you can see by the fact that the stocks continue to go to the upside. So interesting to see, obviously, some resilience with a lot of those kind of names. And that's the sector theme you see at the top. Interesting to see utilities number 3, though. So on a big up day, Utes are actually up 0.5%, a little below the S&P, but still up. On the downside, energy, healthcare, and materials. We've talked about some healthcare names. We highlighted Merck yesterday. We've talked about biotechs recently, and it's interesting to see this group as a whole be underperforming. And again, I think a lot of those names have pulled back to pretty important levels. And this is the point at which you assess whether biotechs are at a buyable bounce, or whether this is the beginning of a further leg down. Again, I think where it holds relative to key support levels can be very key. Worth noting in terms of our top scooter ranked stocks, the number 1 stock now AMD. So we're back away from Tesla and back into the semiconductor space being the top ranked name. And AMD and semiconductors overall, the relative performance has been impressive. And especially since the June market high, look at how a bunch of this outperformance has come really in the last 3 to 4 weeks really on AMD. But look at the breakout, look at this huge base. And when people see big base breakouts like this, if you look, the peak was in February, tested that high in April and May and June and July. We finally break above it in mid-July. I have people that see that and it becomes overbought and they say, hold on a second, it's, you know, it's at resistance. You don't want to be buying that kind of thing. And one thing I've learned from working with institutional growth managers is those are fantastic charts because stocks that break out can go a lot further. So from that breakout level, we closed just above 60. It's now up to 80. It's up another, 30 some percent just on, just from there, just in the last couple of weeks. So, breakouts in general, I found are good opportunities on the long side. It's not opportunities to get hesitant or to hold back. And so, looking at stocks making new 13-week highs and 13-week lows is certainly becoming an important part of my process for sure. One final note, and then we need to take a break. I did want to highlight some of the groups up at the top, and it's interesting to see a return back to some of these coronavirus plays: airlines, travel and tourism, computer hardware. That's not a great example. Hotels. That's what I meant to say. Gambling. These are all groups in the top 10. These are sort of the groups that have been beaten down. Expecting a longer, more drawn out lockdown, potentially a second lockdown of sorts, and what that might do. Worth noting, those stocks all up pretty good. So the gambling group within consumer discretionary up almost 7% today. And again, these are coming off of pretty beaten down levels. And again, the long-term charts of airlines, I would argue, still are pretty negative, definitely in a bearish configuration. But look for these kind of things. And if there's sustainable breakouts, especially through some of the swing highs, that can be pretty interesting. That's our recap. We need to take a quick break, and we'll be back with Julius de Kempenaer. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Appreciate you joining us every weekday after the close for our show. As a reminder, we love to hear from you, and we'll be doing another mailbag segment on Friday's show tomorrow. So 2 ways to get your questions to us. One is via email. Just shoot us at thefinalbar@StockCharts.com, or on Twitter, just tag us in a comment at FinalBarSCTV. And again, we'd love to hear from you, any of your questions on navigating the markets, on technical analysis, on particular charts or tickers. Just shoot them to us. We'll do our best to review them on the air together. I want to welcome on my guest, Julius de Kempenaer. Julius is the founder of RRG Research. He hosts shows Sector Spotlight, as well as other many guest appearances on StockCharts TV. And someone I've known and respected, whose work I've respected for many years. Julius, welcome to the show, my friend.
Thank you, man. Glad to be here.
So we've talked a lot about, issues with rotation, or just this, this situation where stocks, bonds, gold, everything seems to be rising. And now we're thinking about the stock bond relationship. You have I think you have done an exceptional job of promoting this concept of rotation and how to visualize it. Tell us what your toolkit is telling you now about stocks versus bonds.
Yeah, it's, I hate to say it, but it's confusing actually. Not only from an RRG point of view, but in general, I don't know about you, but I got you read what other people say and write, and it's like people want to call the next high, and they point out to the divergences, as you already talked about, and those divergences that were there, and they just got smashed in the last few weeks. There was signals of weakness in various breadth measures. They got smashed. So the market is just not listening to whatever signal the technicals are sending. And to me, that I think I have to take that as a sign of strength. I like to compare it with a sports team when there is a soccer match and you got one very favorite team and you got the underdog, and the favorite team is like pounding and pounding and pounding and pounding, but they cannot get to score. And then all of a sudden it goes around and the underdog scores and runs away with the prize. And that, to me, that looks like what those ratios are now, and those divergences. That's the favorite team. The bearish scenario, the bearish talk. That's the favorite team. And and they just don't score. They cannot push the market down, and then all of a sudden we're breaking away and we're going higher, and everybody's on the sideline watching. When, hey, what's going on here? And you talked about big fund managers that are not they cannot afford not to hold those big stocks. Imagine that a lot of these guys have sold their holdings or part of their holdings. They're
Mm,
now on the sideline, not holding many big name benchmark stocks, and they need to get back in and
yeah.
buy and push it even higher. And that's what I see in the RRG as well. If you got the RRG there for the various asset classes, and I wanted to focus on the relationship between stocks and bonds, and I just use the SPY and IAF rotation for that because it's very clear. And this is the weekly version, and if I just look at this RRG, it says, okay, stocks are leading, they're in the leading quadrant, they've done well, but over the last 2 months, they've been petering off, and they're inside leading, but their rotational path, their heading is not very strong. They're already losing relative momentum. While on the other side, the bond market is inside lagging, but it's already starting to pick up relative momentum. So this is like a
Mm,
very early type rotation that's sending me sort of a like long-term warning signal. Hey, hang on, that trend is in favor of stocks, but I see some weakness coming on. And if you then move that to a daily rotational chart,
yep.
you, you see sort of you see stocks weakening. And I talked about it in Sector Spotlight on Tuesday, and then the last 2-3 observations weren't there yet. And that was like, okay, stocks are now weakening while they are in lagging. So how am I going to how am I going to put those two together? And now you see that SPY is curling up and IEF is starting to roll over.
Hmm.
And it could be the very early stages, because you know that these rotations can take place on one side of the plot, and that means a very strong trend. So
Right.
if I, sort of make a little bit of a fantasy or estimated guess here, SPY could be curling up, IEF could be rolling over, back to lagging and back to leading, and then it
Mm,
would be back into sync with the longer term tails on the weekly that could just pick up a little bit of momentum again and move that longer term trend.
hmm.
Dude, I find it very difficult to read. The rotations seem to go much faster. That's not only in assets, but I also see that happening in sectors where rotations that usually last pretty long are now, in a matter of weeks, they go around. So I find it very, very hard. So I'm keeping a very open mind. What I like is over the last 2 to 3 days, if you look at the ratio chart per se of SPY versus IEF, then that one there, that's now breaking out, seems to be breaking out. This is a weekly chart, so you see that that's now breaking out. So that could be in favor of a continuation of preference for SPY over IEF. But
Mm,
when I look at that, I really love the bond chart. If you bring up that IEF chart,
yep.
that's a monthly. That is, you got to agree with me. That's a fantastic chart. This is
Yes. And a
this is
mentor of mine once said, never confuse the top of the screen with resistance. And this is what we've seen. It just continues to pound away to the upside.
exactly, and it looks like a flag. I actually, because I saw this, I dusted off my Edwards and McGee from my bookshelf and started reading up about it. And it's actually not a flag because it drags on too long. And they
Mm,
actually have a paragraph on that, on flag-like patterns on months and weekly charts, etc. Too long to discuss now. But I just, whether it's a flag or not, it's a consolidation after a straight move up, and we're breaking away from it. So this points to lower yields. Lower yields are usually good for stocks.
yeah.
That could point to higher stock prices even now. So you got to watch this market every day. And I think we tweeted back and forth about how this is now much more a market of stocks rather than a stock market, because I do
Mm.
think that because of the fast rotation, you see big differences in sector performances. So you got to make sure that you're in the right sectors, because otherwise you got beat.
Julius, this was an awesome take. I wish we could talk for another hour on this because this is a great read on it. And I leave everyone just by reminding them when stocks and bonds, when it feels like everything is kind of moving together, I think the RGs are so good at helping you differentiate because it's all relative to a benchmark. So you can spread them out see how they relate to one another. Julius de Kempenaer, listen, thanks so much for coming back on the show. Hope you and the family stay safe in the Netherlands, and talk to you again soon, all right?
You too, and everybody who's listening as well. And by the way, I think you really like my DITC article that I wrote today. For your
All right,
stock
I'll check it out. We'll check it out. Thanks, Julius. Thanks again for coming on.
Welcome.
That's Julius de Kempenaer, founder of RRG Research. He was referring at the end to don't ignore this chart. It's one of the blogs we have on StockCharts.com. And, listen, Julius's work is excellent. And I think what we just looked at, looking at the, asset classes, how they're revolving around a benchmark, looking at two different ones and how they're related. I found working with institutions, being able to visualize when it feels like everything's moving the same way, something like this can help you differentiate those, help you understand the relationships, what's working and what isn't, relative to sort of the average or relative to the benchmark. And now might be a really good time to pay attention to those charts. Our next segment is called Getting Sentimental. One of the things, it came to mind after we had Gary Dean on the show yesterday. Gary's at a shop called sentimenttiming.com. And it was a great reminder, just the value of looking at sentiment and how to think about it. For me, as you may know, if you followed the show for a while or followed my work, I sort of think of the market in order of three major inputs when I'm thinking about the broad market environment. Number one is price. Number two is breadth. Number three is sentiment. And that's in priority order. So price is number one. So if I want to understand what people are thinking, I want to look at how they're voting with their capital. So price represents the aggregate supply and demand, the aggregate fear, the aggregate determination of where people's heads are at, and not just what they're thinking, but what they're actually doing, where their conviction is. Secondary to price is breadth. So it's trying to look under the hood and understand the relationships between the stocks that make up an index and the broad indexes themselves. And that's why we refer to breadth a great deal. And on the Mindful Investor Live chart list, there's a lot of breadth on there because of that. Third for me is sentiment. And sentiment to me, I find interesting for understanding the narrative, for understanding why price is doing a certain thing, understanding why breadth characteristics might tell me something. But for me, sentiment usually is less of a signal on its own. It's more a reason to dig into some of those other inputs. And if I see something from a sentiment chart, I usually look back to price and breadth to understand a little more about what's happening. Now, having said that, there's some people that do a fantastic job looking purely at sentiment. Gary Dean, Woody Dorsey at Sentiment Timing come to mind. Jason Geffert at Sentiment Trader does a really good job there, and there are others for sure. Mark Young at wallstreetsentiment.com. Although they do a very good job of quantifying sentiment in a way that I do not focus on, and again, more power to them for that. But in terms of me and how I think about it, that's kind of where I'm at. So what I wanted to do is just walk through my sentiment list, and this is part of the morning coffee routine chart pack. So if you have these installed, if you installed my chart pack when you created a StockCharts login, you probably already have these on a chart list somewhere. If not, go to our chart list listing and go down to the chart packs, and you'll see one for me that includes this basket of sentiment indicator charts. So for me, I sort of look at four main things. I look at the VIX, which is a measure of volatility using the options market. Second is the AAII survey, so looking at individual investors. The third is looking at positioning. So this is the name exposure index and the RIDEX bull bear ratio. And then finally, the put call ratio using, and again, there are a number of ways to do it, but I use one measure, just a basic put call ratio from the options market as well. Let's look through each of these very quickly, and we'll have our discussion. So first off is volatility. We talked about the VIX recently, and I think it's worth noting that as the S&P has gone higher, sort of on its way to retesting the highs at 3,400, the VIX is now below 25. It's gone to happen in an up market. But the comparison I would make is right now versus maybe 2009. And again, don't completely ruin me for trying to make one comparison to comparing right now to one other point and drawing conclusions. I'm not trying to do that, but I do think it's interesting to look at historical parallels and understand what happened in one historical incident, and then think about what might be different or the same, or how they might be related. And you have a similar pattern. It's the last time the maybe a year and a half to finally get to its low in April of 2010. That's after peaking in October of 2008. You can see here we peaked in early 2020 at the market when the market sold off into the March lows, and from then we've been appreciating as the market's gone higher. So that, what that tells me is even though the volatility has come off a great deal, there's still a lot further to go before it gets a quote unquote normal range, which is really a VIX below 20. So, we haven't gotten there yet. And this may be just a period of extended, of increased volatility, unlike what we've seen in forever. But on the other hand, if you would have another extended bull market, the VIX tends to be relatively muted for longer periods of time. And that's one of the things I would look at here. Spikes in the VIX, changes in the VIX can be telling here. Chart number 2, we're actually going to skip to this one. This is looking at the AAII surveys. This is a weekly S&P chart. This is the bull votes and bear votes in the weekly survey of individual investors, and then the spread between the two. What I'm looking at here is the spread has narrowed pretty significantly over the last week. You still have almost 50% bears. The big change is you've had an increase in bulls from about 20% to about 23%. So an increase in people voting bullish, not much of a decrease in bears, and that's bringing the difference in a little bit. So overall, still very much favoring bears over bulls at about a 2-to-1 ratio, but overall coming in a little bit. Still pretty overall, certainly much more bearishly position than ever. And in general, that tends to be what you see when the market gets heated, is you get some bullishness, or sorry, some extreme bearish readings there. The third one is the name exposure and Ridex bull bear ratio. And basically what you're seeing here is that the name exposure index says money managers are pretty much all in on equities. They're the highest positioning level they can. On its own, that doesn't tell you that's a top, because this indicator actually becomes very positive at the beginning of an up move as well, but it also tends to do this at the end. So I think it's interesting to just see where investors are positioned. I think price is the most telling part of that. Also interesting to see that this Ridex bull bear ratio, it shows you the proportion of bets on the bullish configured securities, things like index funds and sector funds, and also bearish ones and market neutral ones. It's basically at an extreme, high level, extreme low reading, which basically lines up traditionally with market tops. Finally, the put call ratio is relatively low. I'm looking at the 5-day moving average of those daily readings. But if you look at the gray in the background, those are the spikes on the daily reading. You can see we're pretty much at the lowest levels, which again tends to coincide with market top. So in general, sentiment is extended. This is, I think, some of what Gary Dean was telling us yesterday. For me, it tells me to look at the price and anticipate breakdowns in price when the market is ready to turn, and we haven't seen that yet. And I think that's probably the most important conclusion to make. That's it for a sentimental, getting sentimental segment. Let's wrap this show. 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is looking at the AAII bull bear readings with spread. And again, the things I would make, I think I just butchered bull and bear as I was finishing up this chart earlier. So please forgive me if I misspoke. The idea here is the spread between bulls and bears still very much favors bears by a 2-to-1 ratio. And, seeing 50%-ish bearish readings was interesting. We've been down in that range for a lot of this rally. It's a very unloved rally when you look at that particular sentiment measure. Chart number 2 is looking at the put call ratios. Again, I'm concerned by the fact that the put call ratios are extremely low right now, which tends to be a fairly, a bullish positioning, bearish indication, which again tends to coincide with market peaks. You look at when these gray lines are spiking down, when the pink line, which is the average, is sort of at the bottoms, that tends to be a market top, and that's sort of where we're at right about now. Finally, we didn't talk a lot about small versus large cap. With Julius, we're talking a lot about more stocks versus other asset classes, but I think it's worth noting this ratio of small versus large in the last couple of weeks has once again rotated back toward the small cap universe. You didn't see that today with large cap sort of leading the way higher on an update, but overall, the performance of small caps is not something to ignore. And what it tells you is that there are opportunities. Even if the broad market is doing X, if FANG stocks are doing Y, there are opportunities in the mid cap and small cap space. So it's a good time to revisit screens, look for potential long ideas. Folks, that's our show for today. Special thank you to Julius de Kempenaer joining us late in the evening from the Netherlands to share his take on the overall market environment. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.